Hello and welcome to Livewire Markets. I'm Ali Selby, and if there's one theme which has completely taken the world by storm in 2023, it's got to be artificial intelligence or AI. So today we're very lucky to be joined by the CIO and founder of Loftus Peak, Alex Pollak. Alex has been specialising in disruptive investments over the past 30 years, and today he'll be sharing where he sees the most opportunity. Thank you for joining me today, Alex. I'm really excited for this chat.
Thank you for having me.
As I mentioned in the intro there, we've obviously seen this hype around AI. Since ChatGPT was launched in November last year, we've seen companies like NVIDIA soar, I think 160% it was. Is it too late to jump on that trend?
Look, I think what we think is that, the big early money has been made, and so that is correct. But we also think that this is a multi-year exercise. There's another, great quote about the whole thing out of the Atlantic, which was, when the steam engine was invented, people perceived that it was a mechanism for getting water out of mines. But it turned out to be a mechanism for decoupling economic growth from population growth. And AI looks like one of those steam engine-y kind of things that is capable of decoupling productivity growth from, population growth again. And if you look at the history of what has happened and how technology has worked, it has been an ongoing story of better technology has been able to lift people's living standards. Yes, there have been casualties along the way, of course. People have to retrain. People do lose jobs, environmental issues do happen. But there was once a period when the world worried whether they could feed 1 billion people. We're now feeding 7+ billion people. So AI, looks like it is one of those tools that is capable of allowing people to do much, much, much more without a significant amount of energy to do it.
Could this be another bubble?
I don't think it's a bubble. I think there are real world applications for AI which will go for a very, very long time. One of the big companies that's involved in it is Microsoft, and Microsoft has a family of applications for businesses around the world and is one of the largest providers of those applications to enterprise around the world. And that company will add a co-pilot, which means an AI capable entity onto the existing application that you're using, which will significantly improve your productivity. So what does that mean? It means that if you've got a Word document, for argument's sake, and you want to convert it to a PowerPoint document, you say to your AI co-pilot, take this Word document, pull out the most relevant points, put it into a PowerPoint document, put in some graphics that you think are applicable. In addition to that, book me a flight at 3 o'clock tomorrow afternoon to Melbourne, etc., etc. The AI co-pilot that's in the Microsoft application puts that presentation together out of the Word document, books the flight, you check it, etc. So that will take time for people to get comfortable with the level of automation that now becomes capable as a result. And so that's why I say that we've had some early big wins in AI. Now it'll move into the slower game where people really start using the tools, and the companies that use the tools the best will perform the best.
What are those companies and where are you seeing the best growth opportunities?
Well, right now we are still seeing the growth opportunities in the tools companies, the companies that actually make the connecting pieces that AI requires. So the applications companies, for example, like Microsoft, the networking companies like Arista, the chip companies like AMD and TSMC. We see a lot of that going on right now, and obviously Microsoft for the applications and Google for the applications. As well, and possibly something to do with Amazon for the applications as well. And there are a number of others that are highly prospective as well. Qualcomm is another. But it'll take a little bit more time to actually see exactly which companies come out of the blocks with better solutions. You may recall this, right? In the first 5 or 10 years of online retail, it took a few years for Amazon to really emerge as the company that was disrupting retail in the broadest sense. So we'll have to, and that this is what we do inside of our business, we churn through companies, beneficiary companies, enabling companies for AI to try and find those that are most exposed. And obviously our returns are what they are, and they've been very good. So that has worked for us, and I guess as long as our process holds, let's hope it continues to work for us.
Okay. Is there one company within the AI theme that you feel like every investor should have in their portfolio?
Well, one company that every investor should have is Microsoft and NVIDIA. So there's two names there, at least those two names. But I have to say that you have to be very careful, at the price at which you buy those companies, because, they go through periods where their pricing is, expensive or cheaper. New data points emerge which change the expensiveness or the cheapness of the companies. And so it's not a set and forget thing, right? We have a team of people that are constantly reassessing valuations on the basis of new data points that come out of, developments in AI. And it's a curly business, right? It's not simple.
Where else are you seeing disruptive innovation and opportunities today?
Well, one area that's very interesting is the work that AI is doing in the biosciences. Drug discovery, protein folding for genetic markers, all of that is very interesting. So there may be some medical things that come out of AI that are important.
Let's talk about investing offshore as an Australian investor. The AED has cascaded around 8% over the last few months to 66 US cents. How does that impact investors who are investing overseas?
A falling Australian dollar renders your offshore exposure more valuable for obvious reasons, because when you translate it back into Australian dollars, you get an 8% kicker for the exact investment that you bought, because your US dollar now buys 8% more dollar value of Australian dollars. We have always believed that a solid exposure to the US dollar, and to some degree the euros and pounds, etc., is a good thing for a sort of resources-based economy with a bit of retail and a bit of banking thrown into it in Australia, because those countries provide the industries that are the engines of growth, and therefore their currencies are likely to do better, and they have been doing better. And that's good for Australian investors in offshore companies. So it's a free kick.
Okay. I want to talk about the macro outlook. It feels like dreams of a soft landing may be coming to fruition. What's your take?
We had the big inflation scare and historic level of rate rise growth all through 22 and even a bit of 23. The Fed taps the brakes, right? And smaller banks go through the windscreen, right? And that's what happened. Silicon Valley Bank went, and I note this morning, Moody's has downgraded a number of regional banks as well. And what that does is it severely limits the Fed's ability to raise rates more. So it's like this: don't listen to what they say, look at what's going on around them. And what's going on around them is that the inflation numbers are winding back, tick. The GDP numbers are okay, tick. Unemployment rate is okay, tick. And the suggestion that there's going to be another rate rise would precipitate another round of downgrades of the regional banks, and may even take a big bank with it, and possibly even cause a banking crisis in the US. I mean, don't get me wrong, I'm not suggesting there's a banking crisis happening, and I would never suggest that, because that's most unwise. But in Powell's mind, he will be sitting there saying, the economy, generally speaking, things are okay, inflation's down, there is no clear and present danger that exists that would require me to raise rates, and if I did raise rates, there may be a clear and present danger.
What does that mean for investors then?
It's rare that we get, all of the inputs lining up. So US GDP is lining up, inflation's lining up, interest rates are lining up. It's probably quite a good time right now. It has been. We've had very solid returns since the beginning of the year. It's been a very good time, and there's nothing really on the horizon that should break that in the short to medium term. That's our read on it.
So we're going
it's a bit of a
Goldilocks. That's what it sounds like.
There's a little bit of Goldilocks out there. That can change, but actually it looks a little Goldilocks to us. A lot of things are going the right way.
That definitely makes me feel very excited. I hope you haven't called the bell on the market by saying that, but that definitely feels exciting for investors.
I don't think that this is the bell. I think there's another few months of reasonably good numbers to be had.
Okay, last question for today. You've been working in markets for 30 years. Is there something that you've learnt recently that you would like to share with investors today, or maybe something that's really been building up from those 30 years of working in markets?
Well, one thing that we absolutely believe is that real specificity around what it is that you're investing in is absolutely critical. You have to ask yourself the right question and ask the right question of your investee companies in order to get the answer that you want. There are a number of different ways to play, for example, the electric car, and you may want to buy lithium stocks for argument's sake, and maybe there's exposure to that in Rio or BHP, etc., etc. And you might think, well, I could just do that and that would give me some exposure to this, but to batteries and cars, etc. Our comment is it's much more granular than that. You have to kind of understand exactly how much exposure, what the economics are behind extracting lithium, so to speak, the problems with shipping it, the environmental problems around producing it, the end product itself and the quality of it. And so unless you are really very specifically considering those sorts of issues, then you're not likely to get, you may be lucky and get an investment outcome that you like, but you are leaving a lot more open to luck. And
it's kind of more gambling, isn't it?
Well, it can work. It's not what we do. We are totally specific about the economics of even within individual companies.
What metrics do you use when it comes to those economics, just so investors can write them down as something they should be paying attention to?
We use long-lived DCF calculations. So we look at what the company is likely to do over a 5 to 10 year period. We have never focused on quarterly numbers. I mean, we use them as data points, but we never use them as the basis for investment. I'll tell you why. Back when we invested in Amazon all those years ago, we invested in it before it was widely understood what they were doing with respect to Amazon Worldwide Services, the cloud business. We became aware through our research that the business was very, very widely patronised by Fortune 500 companies. Kellogg's, Condé Nast, the names, there was dozens and dozens of names and testimonials. And yet there was no breakout line in the Amazon P&L for what AWS were doing. But we could see that there was billions of dollars worth of revenue that must be being paid. And so that granular focus on what was going on inside of AWS enabled us to buy with much more confidence, and then the AWS story was revealed. AWS is now a bigger business than retail, and we've ridden that thing all the way up. We have similar growth stories nestled, hidden, which is the way we like it, within our companies that will drive the next 3 to 5 years growth.
Okay, Alex, thank you so much for your time today. I really enjoyed that chat. If you enjoyed it too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content every single week.